What's going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis for Thermo Fisher Scientific. This is ticker TMO. In the last year, this stock had some volatility, but it's nearly flat. The description for what this company does is as follows: the provision of analytical instruments, equipment, consumables, software, services for research, analysis, discovery, and diagnostics. It operates through life sciences, analytical instruments, specialty diagnostics, and laboratory products and services. They do a lot of different things. So this market cap is 193 billion. It's a pretty big company. And I first came across this company because when I would look at what other hedge funds and big investors were investing in, this was a popular one. So just in the last quarter, we can see that there's several funds that are adding quite a bit of shares to their portfolio, with this one, TCI Fund Management, adding over 2.3 million shares. So let's start by looking at their revenue here. In the last 5 years, they've averaged 16% revenue growth, 16%, very good. And last year, they did a whopping $45 billion of revenue. Now, to make it even better, their net income chart is also growing at even a faster clip at about 25% per year in the last 5 years. And they did nearly $7 billion of net income, which is very strong. If we take a look at their price to earnings, we're going to see that it trades at about 34 times trailing earnings right now. And although that's in the range that it's been at in the last 5 to 6 years, it's definitely on the higher side. So I think it's very realistic to expect this stock to come down and trade at maybe 30 times earnings. So if you were to buy it at today's price, I wouldn't be surprised if it came down 10, 20, possibly even 30%. That's why I wouldn't be super quick to jump on and buy the stock today. Then if we look at the next one, we're going to see that, is the company innovative? I would say yes. That's pretty much what their job is as a company, is to continue innovation. So I would say yes. Strong market share, I put yes, although when you research it, it comes up 5%. A lot of times when you research market share numbers, you get a bunch of different answers. And although it says 5%, I think that a company that's doing $45 billion of revenue, that means they have a significant share. I don't think you could be a small company doing $43 billion of revenue. So I'm going to give that a check. Return on invested capital is about 10%. So it's good, but not amazing, but it deserves the check. The equity, this one is very interesting. So equity is growing, but the weird thing is that I'm not sure what happened this year, but somehow their equity went from 29 to 34 to only 122 million, and then back to $44 billion. So something happened here where their liabilities nearly doubled. No, their liabilities tripled from 2020 to 2021, causing them to lose over $34 billion of equity, which is crazy. And then somehow they eliminated that $45 billion of liability of equity. So, but the long-term trend is still strong. Going from 29 to 44 billion in 4 years, or 3 years really, is really strong. That'll get a check. It's definitely over 15%. The share count is not, I put yes because it's pretty much flat. It's a slight decrease. It's a slight decrease in the last couple of years, so it's technically a check, but not by much. The asset, now this one is interesting because a lot of times bigger companies, you're not going to find a big company that has double the assets than they do liabilities, but this company is very close. They didn't quite do it, but they are extremely close. All they need is $6 billion more of assets, and their ratio would be 2 to 1. So this company is actually better than most. Profit margin is 15%, so that's strong. Cash receivables is 11 billion, which is nearly double their annual income. The company has a dividend, it's consistent, and the payout ratio is only 9%. So they definitely could raise the dividend, but that's okay because that probably means they're investing back into the company. The company is over 10 years old, and their free cash flow is improving at about an average of 14% growth per year, with adjusted free cash flow being 6.6 billion last year, regular free cash flow being 6.9. So again, they're barely buying back shares, so that shouldn't make a huge change, but overall the trend is pretty good. We're looking at about 14% growth per year. So I would be slightly interested. I would be slightly interested in this if the valuation came down, but only in that case, really. And the return on invested capital is, where's the ROI number? It is what? It's like 10%. So it's not super strong. I normally like to find companies that can do at least 20% ROI. So that wouldn't really fit in that category. But thank you for watching. I will see you guys in the next video.